If you received a Social Security check in January 2026, there is a very good chance you missed several $100s that were actually yours by law, and that money is still sitting in the system unclaimed right now. Quick note before we jump in, this is educational content, not professional tax or financial advice, so make sure you verify anything I mention with your own CPA or financial advisor for your specific situation. That said, what I'm about to walk you through is happening to millions of seniors right now, and the action steps are simple enough that you can complete them yourself this week. And for the last 15 years, I have been helping retirees navigate the exact situations we're about to cover. The three changes I want to talk about today all came into effect between late 2024 and early 2026. And here's the crucial part. None of them came with an automatic notification. Social Security didn't send you a letter. The IRS didn't email you. Your Medicare plan didn't call you. But the money is there, and it's yours if you know the specific moves to make right now. The scenario that prompted me to make this video is what happened to Martha and Ron, a married couple I work with, who both turned 66 in 2025. In January, Martha's Social Security check arrived, and they were expecting a $72 increase from the 2.8% annual adjustment. When Ron checked the account, the deposit was smaller than expected, only $38 more than December. Martha immediately assumed the government had made an error. That was not the case. What actually happened was that Medicare Part B premium went up by $17.90 in the same month, reducing the net benefit of the annual increase before it ever hit their account. But here's the part Martha and Ron did not know. Because Martha retired in 2024 based on prior year income, she was also paying an additional Medicare surcharge called IRMAA that was eating away at her check every single month. That surcharge was worth $81.10 monthly, added on top of her regular premium. She had no idea it was recoverable with a single form. Ron had filed his 2025 taxes without claiming a new $6,000 senior bonus deduction that he was entitled to. His tax preparer simply wasn't yet familiar with the new rule and didn't apply it. And both of them were taking expensive medications for heart conditions and arthritis, where they had already spent $1,800 on out-of-pocket drug costs by June, not realizing they were close to hitting a hard annual cap that would make all covered medications free for the rest of the year. When we worked through all three situations together, Martha and Ron identified nearly $4,000 in benefits and refunds they were entitled to but had not yet claimed. That's the exact situation we're addressing today. Here are the three specific changes that apply to your retirement right now, how they affect your actual monthly income, and what you need to do this week to capture the benefit. Change number 1, the Social Security COLA and the hidden Medicare premium trap. In January 2026, every Social Security recipient got a 2.8% increase in their benefit. For someone receiving the average benefit of $2,015 per month, that sounds like a $76 monthly raise. But if you're on Medicare and if you're on Social Security, statistically you are on Medicare, your real increase is significantly smaller because Medicare Part B premiums increased at the exact same time. The Part B premium went from $185 in 2025 to $202.90 in 2026. That is a $17.90 increase monthly. So for that person with a $2,015 average benefit, the real net deposit increase was approximately $38, not $76. Nearly 50% of the COLA increase was absorbed before the money hit the account. Most retirees discover this when they see the deposit and feel disappointed that it's smaller than the headline number suggested. But the headline number was never the number that was coming to you. The net number was always going to be different because of the premium increase. Here's where it gets more important. If your income was higher 2 years ago and Medicare uses a 2-year look back on your tax return, you might be paying something called an IRMAA surcharge on top of your regular Part B premium. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is an additional charge that kicks in when your prior year income exceeded certain thresholds. These thresholds are $97,000 for a single filer and $194,000 for a married couple filing jointly. If your 2024 tax return showed income above those numbers, Medicare added surcharges to your premiums in 2026, starting in January. Here is a concrete example. Sarah was a high-income earner who worked until mid-2024. Her 2024 tax return showed $135,000 in income because she had 6 months of her final salary plus investment income. Even though she retired completely in September 2024 and is no longer earning any work income whatsoever, Medicare's 2-year lookback means her 2026 premiums are based on that $135,000 2024 return. That puts her in Tier 2 IRMAA, which adds $202.40 monthly to her Part B premium alone. That surcharge has nothing to do with her current actual income. She hasn't earned $1 of income in over 6 months, but she is paying $202 extra every month in 2026 based on income from the previous year. The action for this situation is a specific form called SSA 44. It is the life-changing event notification form. If your income decreased significantly between 2024 and now, and retirement absolutely counts as a life-changing event, you can file this form and ask Social Security to recalculate your Medicare premiums based on your current income instead of your 2024 income. Sarah can file the SSA 44, provide documentation of her retirement date and current income, which could be just a pension statement if that's her only income now, and Medicare will recalculate. Her surcharge will likely be eliminated, recovering $202.40 per month, starting 60 to 90 days after she files. That is $2,400 per year that she's leaving on the table by not filing. The form is available at ssa.gov. You do not need to go anywhere in person. You can mail it or submit it to your local Social Security office. The key documents are your retirement notification letter from your employer, your most recent tax return showing current income, or a pension statement showing what you're actually receiving monthly. You can file this form anytime, but every month you wait is a month you're overpaying. One more critical misunderstanding that I see constantly. Seniors assume that when they file their 2025 tax return later this month, showing lower income, Social Security will automatically recalculate their 2026 premiums. This is not how it works. The 2-year lookback means your 2025 return will affect your 2027 premiums, not your 2026 premiums. If you need a 2026 correction, the SSA 44 is the only mechanism. Your 2025 tax return will handle the 2027 correction automatically through the normal process. But 2026 requires the form if your situation has changed. Change number 2, the senior bonus deduction that most retirees never claimed. In 2025, Congress created a new federal income tax deduction specifically for people over 65. This is the senior bonus deduction, and it is worth $6,000 if you're a single filer over 65, or $12,000 if you're married and both spouses are over 65. This deduction applies to income you earned or received in 2025, the year most of you have already filed your tax returns for. Let me show you the dollar impact. A single retiree over 65 in the 22% federal tax bracket gets $1,320 in direct tax saving from that $6,000 deduction. A married couple both over 65 in the same bracket gets $2,640 in tax saving from the $12,000 deduction. For many retirees, this deduction completely eliminated their federal income tax liability, turning every dollar of federal tax that was withheld from their Social Security checks in 2025 into a refund they can claim back. Here's the problem in June 2026. The deadline to file your 2025 tax return is April 15th. Most of you have already filed, but a significant number of people who filed early, particularly those who used preparers in January or February, had their returns filed before these preparers were fully familiar with the new rule. The result is that this deduction was missed on thousands of returns that were filed correctly otherwise. The preparer just didn't know about it yet, or basic tax software that wasn't updated didn't flag the change. Here's a concrete example. Robert is 67 years old and single. His only income in 2025 was his Social Security benefit of $24,000 and about $3,000 in interest and dividends. He filed his tax return in early February using the same online tax software he has used for years. His tax preparer, who was himself a retiree doing part-time tax prep, hadn't yet seen the new rule and didn't mention it. Robert's return was filed without the $6,000 senior deduction applied. His tax liability was calculated as $800 in federal income tax owed. Because he had Social Security withholding of $1,200 throughout 2025, he would normally expect a $400 refund. But here is what actually should have happened. With the $6,000 deduction applied, his taxable income drops below the threshold where any of his Social Security is taxable at all. His actual federal tax liability becomes zero. Not $800 owed, but zero. His refund is not $400. It is $1,200, the entire amount of withholding he had taken out. The difference between what Robert's return showed and what it should have shown is an $800 understatement of the refund he is entitled to. The action for this is straightforward. Go look at your filed 2025 tax return. Find your Form 1040. Look at the line labeled Standard Deduction. The amount on that line should include not just the base standard deduction of $15,000 for a single person over 65, but an additional $6,000 senior deduction, bringing the total standard deduction to $21,000. If it doesn't, the deduction was missed. If you're married filing jointly and both over 65, the line should show $35,000, $30,000 base plus $5,000 for being over 65, but that's not the new rule. The new rule adds an additional $6,000 per spouse, so the total should be $41,000. If it shows anything less, the deduction wasn't applied. If your return is missing the deduction, you file what is called an amended return using Form 1040-X. The IRS processing window for amended 2025 returns doesn't close until April 15, 2029, so you have time. But here's the incentive to do it sooner. Every month you wait is a month that refund is sitting with the IRS instead of in your bank account. If you amend your return today and your refund is $800, that $800 can be back in your account within 6 to 8 weeks typically. If you wait until next year, you've given the government an interest-free loan of $800 for 12 more months. For many retirees, that's meaningful money. Here's the second piece of this that matters if you're still working or you're still taking taxable income. If you had federal income tax withheld from your Social Security benefit in 2025 using what's called the W-4V form, you should recalculate whether you still need that withholding in 2026. The senior bonus deduction reduces your taxable income for 2026 as well. If the deduction brings your actual tax liability to zero or close to zero, continuing to have federal tax withheld from your Social Security is money you're letting them take that you're just going to claim back as a refund the following year. You stop the withholding by filing a new W-4V with your Social Security office. That returns the money to your monthly deposit going forward. For someone in Robert's situation, if that $600 annual withholding becomes unnecessary because the senior deduction zeroes out his tax liability, stopping the withholding puts $50 back in his pocket every single month. That is $600 annually that he no longer has to wait until the following year to get back as a refund. It goes directly into his Social Security check starting the month after he files the new W-4V. Change number 3. The Medicare Part D out-of-pocket cap that most seniors have already hit. Starting in 2025 and continuing now in 2026, every Medicare Part D prescription drug plan has a hard annual cap on out-of-pocket spending by the individual. In 2026, that cap is $2,100. Here's what that means in plain terms. Once you have paid $2,100 out of your own pocket for covered prescription medications during the calendar year, your out-of-pocket cost for all additional covered medications for the rest of that year drops to zero. The insurance covers it completely. You pay nothing at the pharmacy counter. Before this cap existed, seniors taking expensive medications for chronic conditions like cancer, diabetes, heart disease, or rheumatoid arthritis faced catastrophic costs. A single specialty drug could cost several $100s monthly in cost sharing. A patient on 3 medications could easily spend $10,000, $15,000, or even $20,000 annually on medication costs alone. That exposure is now capped at $2,100. The moment you hit that threshold, all additional covered medications are free for the rest of the year. Most people don't know when they've hit the cap because nobody sends you a notification. Social Security doesn't call you. Medicare doesn't email you. Your Part D plan sends it to you as a detail in your member portal if you log in and look for it, but they don't proactively tell you. So most seniors who hit the cap keep paying at the pharmacy because they don't realize they've already crossed the threshold and the insurance is supposed to cover the rest. Here's a concrete example. James is 74 years old and takes 5 medications for his blood pressure, heart condition, and arthritis. His Part D plan has a moderate deductible, so he spent his first $400 out of pocket on prescriptions between January and March. By April, the deductible was met, and his cost sharing dropped to 25% copays. He paid $135 in April, $142 in May, and $128 in June. By early July, his year-to-date out-of-pocket spending totaled approximately $1,900. In July, he filled a prescription that cost $320 in cost sharing, but because his prior spending put him at $1,900, that $320 fill brings him to $2,220, which is above the $2,100 cap. His pharmacy charged him $40 out of pocket for that prescription, which is the standard copay. But he should have been charged nothing because he crossed the cap with that fill. Every prescription he fills for the rest of 2026, August through December, 5 full months, should cost him $0 because the insurance now covers it completely. Most patients don't realize this, so they keep paying the copays, and the insurance coverage kicks in without the patient ever knowing they were entitled to free medication. James ended up paying another $600 in copays from August through December that he should not have paid because he didn't know he had crossed the cap in July. The action for this in June is very simple. Contact your Part D plan this week. You can call the number on the back of your insurance card or log into your member portal online and ask for your year-to-date out-of-pocket spending total. Ask them specifically, how much have I spent out-of-pocket on covered medications from January through today? Most Part D plans can tell you that number in real time. If you have already reached $2,100, confirm with your pharmacy that they understand you have hit the cap. If you filled a prescription this week and the pharmacy charged you a copay, but you have already hit the cap, call your plan and request a reversal of that charge. Many plans will push the credit back to the pharmacy immediately, and you'll see a refund within a business day or two. If you have not yet reached the cap, but you are on medications that will take you close to it by year-end, say you're at $1,800 by June, and your monthly medication costs are $200, mark October 15th on your calendar. That is when Medicare's annual open enrollment period begins. During that window, you can switch to a different Part D plan if your current plan is not providing good coverage for your specific medications. You go to Medicare.gov and use their Plan Finder tool. Enter your specific medications, and it will show you every Part D plan available in your area, ranked by estimated annual cost. The plan with the lowest monthly premium is frequently not the plan with the lowest total cost for your specific drug list. A plan might have a $4 monthly premium, but a higher deductible and copays that make it more expensive overall. The plan with an $8 premium might have lower cost sharing that makes it actually cheaper for your specific medications. The Plan Finder makes that comparison visible instantly. Spend an hour in October comparing plans based on your actual drug list, and you can easily save hundreds of dollars in 2027 compared to your current plan. Also worth knowing, if your income is below approximately $22,000 as a single person or $30,000 as a married couple, you qualify for a program called Extra Help, which is administered by the Social Security Administration. Extra Help can reduce your Part D premiums and out-of-pocket costs dramatically. For eligible seniors, Extra Help can mean paying almost nothing in prescription costs. You apply through SSA.gov or by calling Social Security directly at 1-800-772-1213. Getting on Extra Help this year doesn't require waiting for enrollment period. You can apply anytime and coverage can start retroactively the first day of the month you applied. Now here is where all three of these changes connect together. The COLA increase that arrived in January was only partially net income for you because the Medicare premium went up simultaneously. If that premium increase was amplified by an IRMAA surcharge based on prior year income that no longer reflects your situation, you have a specific form that recovers that money. The senior bonus deduction that applied to your 2025 taxes is worth real money, anywhere from $1,300 to $2,600 directly, but only if it was actually claimed on your return. If it wasn't, A single amended return form recovers it. The Part D out-of-pocket cap is now capping your medication costs at a level that would have been considered a complete dream scenario 10 years ago. But you're only capturing that benefit if you know when you've hit the cap and verify it with your plan. The pattern here is the same in all three situations. The benefit exists by law, but you have to take a specific action to claim it. Nobody is going to notify you. Nobody is going to call. The money doesn't automatically show up. You have to know it's there, and you have to be specific about the steps. The 3-number checkup for this week. I want to give you an exact 3-item checklist that will take you maybe 90 minutes total to work through, and that will either confirm you're capturing these benefits or identify where you need to take action. First, pull up your January 2026 Social Security deposit and compare it to your December 2025 deposit. Calculate the difference in dollars. That is your actual net COLA increase. If it's significantly less than the headline 2.8% number suggested, you now understand why. Medicare premium increases are built into that calculation. If the net increase is lower than you'd expect and you retired recently on income that would trigger an IRMAA surcharge, download Form SSA 44 from ssa.gov and gather your retirement documentation. File it this week. Second, open your filed 2025 tax return and look at your Form 1040 standard deduction line. If you're over 65 and single, it should be $21,000. If you're married filing jointly and both over 65, it should be $41,000. If it's lower than that, the senior bonus deduction was missed. Contact your tax preparer or plan to file an amended Form 1040-X. Get the amendment out this month. Additionally, if you're having federal tax withheld from your Social Security using a W-4V, recalculate your actual 2026 liability with the senior deduction included. If you now owe zero or close to zero, file a new W-4V, stopping the withholding so that money goes into your monthly check instead of being withheld and refunded later. Third, contact your Part D plan or log into your member portal and get your exact year-to-date out-of-pocket spending on covered prescription drugs. Ask them, where am I relative to the $2,100 cap? If you've hit it, confirm your pharmacy understands you should be charged $0 for covered medications going forward. If you haven't hit it yet but will be close by year-end, mark October 15th as the reminder to compare Part D plans for 2027. If your income qualifies, look into extra help through Social Security. These 3 actions are straightforward, specific, and directly connected to money that is yours. The real constraint is not complexity, it's awareness. Most retirees haven't done any of these 3 things because they didn't know they needed to. You now do. The action steps here are not talk to a financial advisor or consult with a professional. I'm giving you the actual forms, the actual websites, and the actual phone numbers so you can move on it yourself right now if you choose to. If you found this video useful, subscribe to the channel so you get these kinds of retirement tax strategies every single week. The next one we're making is going to dive specifically into RMD calculations and how to strategically time IRA withdrawals to minimize your tax bracket in a given year, which creates some surprising planning opportunities most retirees don't realize exist. I'll see you in the next one.